Hey, what's going on everyone? It's Griffin here, and in today's video, I want to go over one of the main reasons why new dividend investors can very easily be fooled into thinking that they're investing in high dividend paying companies, when in reality, their overall returns are either staying stagnant or even losing value month after month. This is an issue that I'm really excited to dive into in this video with you guys because I think it's going to be really eye-opening for a lot of you guys, and by the end of the video, you should be in a better position to make an overall global assessment of a dividend stock instead of making this one simple mistake that a lot of new dividend investors make when they're just starting out. Now, if you're watching today's video, then it's obviously because you're interested in investing your funds in the stock market and therefore creating greater wealth for yourself. If that's not the reason, well, to be honest, I'm not really sure why you're watching a dividend investing video, but nonetheless, generally speaking, when you want to invest your funds in the stock market, it's because you want to create further wealth, make your money work for you, and certainly not lose money. But unfortunately, as many beginners do in pretty much any space of activity, gathering the correct information and then applying it in a beneficial manner can be very difficult and challenging at times, therefore leading to shortcuts and using seemingly quick and easy ways to get to the finish line. You know, that was a pretty nice and politically correct way of saying most people are easily corrupted by the idea of high yields, fast gains, and don't really want to wait out a nice time horizon when investing their funds. And by the way, if right now what we're talking about, you're thinking to yourself, man, I don't even know what dividends, dividend yields, and other basic terms are relating to stock market investing, then make sure to check out the video that I'm overlaying right now. There's a link down in the description where you'll get a basic foundation of stock market terms. Also, make sure to check out this content in written blog format over on my website, griffinmilks.com. There's a link down in the description where you'll be able to access all my articles and blog posts related to investing, saving, and a bunch of other really awesome topics, so make sure to check that out. And last point, really quick here, if at any point in the video you're enjoying the content and finding value, then make sure to give it a thumbs up. It really helps the channel grow and spread this knowledge to more people. So on that note, let's dive right into one of the main reasons why new dividend investors typically lose in the short and long term, and how you can go about winning as an investor in the short and long term by applying diligent, risk-averse practices in your investing. Alright, so dividend investing is basically the practice of investing your funds into profitable companies that are fiscally able to redistribute a portion of their profits back to shareholders, you and I, simply for holding shares of their stock. So when a company does have net income from operations, the board of directors can choose to do a variety of different things with those funds, such as, for example, enter new markets, buy a bunch of assets, buy other companies, and even pay out dividends to their shareholders. Some companies have even chosen to pay out dividends to their shareholders on a consistent basis for multiple years, and therefore it's become somewhat expected that those companies are going to continue paying out dividends and raising them as time goes on. In the United States, for example, if a company pays out dividends for a period of 25 years and never misses a payment, as well as continues to raise those dividend payments year after year, then they fall into what's called a dividend aristocrat category. Unfortunately, in Canada, there aren't that many companies that have had that criteria for 25 years, but nonetheless, there's a bunch of really great dividend paying companies and funds that you can choose from. There's links down in the description to videos where we cover a bunch of really great dividend paying assets. Okay, but why am I mentioning all this and why should you care? I mean, what about all this stuff is making dividend investors lose, as I've mentioned in the thumbnail? Well, it comes down to the overall returns of an investment when taking into account dividend payments as well as capital growth in share value of your assets. See, what a lot of new investors do when they first get into dividend investing, and it's really unfortunate because it's one of the main reasons why these people lose money, which really saddens me, but most beginner dividend investors really don't fully understand what a dividend yield and how a dividend yield is impacted by share price and dividend payout, leading to people investing in the highest yielding company at face value without looking at an overall global portrait of the investment as a whole. First things first, to understand the point that I'm trying to make here, you really have to have a strong, solid understanding of what is a dividend yield and how it's impacted. So we're about to quickly check that out right now. A dividend yield is the percentage between a company's dividend payout in a full calendar year and the current price of one share. Notice that I said current because this is super important. For example, a company that has a share price of $100 and that pays out a $1 dividend per quarter would pay out a total dividend of $4 in a year and thus has a 4% dividend yield. So at this precise point in time, the yield is 4%. However, if said company has posted dividend payouts for the year of $4 a share, but the price plummets to $50 in the same day, well then the dividend yield automatically jumps to 8%. Your yield though will not be 8% because you bought in at $100 a share. So based on your dividend income, your investment yield is still 4%. Now, this is a more dramatic example, and most likely the share price of your investments isn't going to plummet by 50% in one day, but it was just a visual example of how dividend yields work and why they fluctuate throughout the day. As soon as a company's share price fluctuates throughout the day as trades are made, then the dividend yield is also impacted. So in the hypothetical example that we just looked at there, if the share price plummeted down to $50, well, your dividend yield is still at 8%. However, if the company cut the dividends in half, going from $4 a year to $2 a year, well, in that scenario, granted that the share price would stay at $50, the dividend yield at face value on the quote of the stock would still be at 4%. So you might be thinking that nothing has changed, when in reality, this is a double-edged sword, because not only are you losing money with lower dividend payout from a dividend cut, but you're also losing money in share value. So you're bleeding out in two ways. So hopefully this makes sense to you, because it's really important to have a strong understanding of that concept for what we're about to look at right now. When looking to buy some new shares in a company, the worst thing that you can do as a dividend investor is only look at the dividend yield of a company at face value without assessing other criteria for that stock. I know that this concept might be difficult to materialize in your mind and have a really nice clear picture, and I'm also a really visual learner, so for this reason I want to look at two different companies, one that has a high yield but that isn't necessarily a good dividend investment, and then another company that has a much lower yield, but in the overall performance of that investment, it's a much better investment. So we're going to be looking at two companies and comparing them side to side. The first company we're going to be looking at here is the Canadian bank TD Canada Trust, currently trading around $76 at the time of filming this video, and has a dividend yield of around 3.89%, which again might fluctuate by the time this video comes out. Now, this is a company I've spoken about in some previous videos because it's a really solid company, has great financials, and pays out great dividends. If you want to know more about this dividend stock, then make sure to check out the video that's overlaying right here. There's a link down in the description, but what we're interested in right now is share price and dividend yield. So at surface value, a 3.89% dividend yield is actually pretty good, I'll be honest, but it isn't necessarily anything crazy like, say, an 8, 9, 10% yield that you can see in other companies. However, let's compare what a $5,000 investment made back in 2015 would look like today with share value and dividends taken into consideration. And by the way, disclaimer here, just for the sake of ease of calculations here, I'm not going to be factoring in reinvesting the dividends because it would complicate the calculation quite a bit, and I want to just simply visualize this for you guys. Okay, so starting with TD back in November 2015, the price of one TD share was around $54, meaning that since then the stock price of TD has gone up by around 41%. So $5,000 invested in TD in November 2015 would have given you 92.6 shares, meaning that now the value of those shares would be roughly $7,138, but it certainly doesn't end here because we haven't factored in the dividend payments yet. When looking at the dividend history of TD, it's evident that they not only consistently pay out their dividends, but they also raise them as time progresses. In November of 2015, they were paying out a 51-cent dividend per share, meaning that your $5,000 investment would represent a $46.92 dividend payout. To save you and this video some time, I've gone right ahead and calculated all the dividend payments that you would have received in a calendar year for 2015 all the way to 2019. So let's look at those right now. As we can see here, between 2015 and 2019, your dividend payments are roughly between $200 and $270. And when combined all together, this equates to a total of $973.83 in dividend payments over the full period. And that's not even counting the fact that had you reinvested those dividends, we'd likely be looking at an even higher dividend payout with more capital appreciation because you'd own more shares and therefore have more dividend payouts. So when looking at the overall return of your TD investment of $5,000 back in 2015, by the time 2019 rolls around, the dividend payment combined with the actual growth of your principal would equate to about a 62% gain at a portfolio value of $8,111.83 on average. Great, so now that we've looked at a really good example of investing in a quality company that not only pays dividends out consistently and raises them over time, as well as having really good capital growth and share price appreciation, let's look at another example with a company that has a much higher dividend yield at face value, but that isn't necessarily going to give you as much of a positive return over the same period of time. For this example, we're going to be looking at Boston Pizza Royalties Income Fund, which at face value has a 9.4% dividend yield, which could be really attractive to dividend investors. By taking the same starting capital as with TD, a $5,000 investment in Boston Pizza back in November of 2015 would give me about 278 shares in the company, translating into a value in today's market of $4,075.48, so almost a $1,000 loss in that period of time. So this right off the bat is a principal loss of around 18.3%. But wait, everything's going to be fine because the dividend payments are really high and therefore it's going to counterbalance the bleeding capital loss, right? Well, let's find that out right now. When looking at the dividend history of bpf.un, we can see that dividend payouts are monthly, which could be attractive to some investors who want monthly income, but the company is somewhat erratic in their cutting of dividends, and it certainly has not been following an upward pattern. All right, now again, for the sake of time in this video and for your time, I'm gonna pre-calculate all these dividend payouts for the year. So let's look at that, right? On average here, the dividend payouts from 2015 to 2019 are much higher than those from TD Bank. And combined all together here, we're looking at a total of $1,466.73 of dividend payments, which is significantly higher than the TD dividends. But when combined with the overall capital loss of $924.52, we're looking at an overall gain of only $542.21. So even though your dividend payouts are much higher and the dividend yield was a lot higher at face value, you're still bleeding out through capital loss, and in the overall picture, you're at a loss compared to investing in a solid dividend paying company. The moral of the video here, guys, is when investing in dividend paying companies, look much farther than simply the dividend yield itself, because understanding how dividend yield works can really give you some insight as to how the company is performing and if the dividend yield is going to stay constant over the long run, as well as how it's impacted by the capital gains or losses of the share value. It's really unfortunate that a lot of people don't know this when starting to dividend invest, and I make these videos to really give you guys some insight and more knowledge as to how you can go about investing in the stock market in a safe and prudent way, because ultimately the goal here is for you guys to succeed with your stock market portfolios. Make sure to check out the other videos on my channel and check out my blog griffinmilks.com, where we cover all these topics in a written blog format. So on that note, make sure to like this video if it gave you value, and I'll see you in the next video.